The Federal Reserve, often referred to as the Fed, plays a crucial role in controlling monetary policy in the United States. Established in 1913, the Federal Reserve is the central banking system of the U.S. and operates with the primary objectives of fostering economic stability, maximizing employment, and maintaining price stability. The Fed's influence on monetary policy is achieved through a range of tools and mechanisms. Here is an overview of the key aspects of the Federal Reserve's role in controlling monetary policy. 1. Setting the federal funds rate. Primary interest rate. The Federal Reserve influences short-term interest rates, particularly the federal funds rate. This is the interest rate at which banks lend to each other overnight. By setting the federal funds rate, the Fed can encourage or discourage borrowing and spending. Open market operations. The Fed conducts open market operations, buying and selling government securities in the open market. These transactions influence the supply of money in the banking system, affecting short-term interest rates. 2. Discount rate. Borrowing costs for banks. The discount rate is the interest rate at which banks can borrow directly from the Federal Reserve. By adjusting the discount rate, the Fed can influence the cost of borrowing for banks, impacting their lending behavior. 3. Reserve requirements. Bank reserves. The Federal Reserve sets reserve requirements, specifying the amount of funds that banks must hold in reserve against certain deposit liabilities. Adjusting reserve requirements affects the amount of money banks can lend, influencing the overall money supply. 4. Forward guidance. Communicating policy intentions. The Fed uses forward guidance to communicate its intentions regarding future monetary policy. Clear communication helps shape expectations in financial markets, influencing interest rates and investment decisions. 5. Quantitative easing, QE. Asset purchases. In times of economic stress, the Fed may implement quantitative easing by purchasing financial assets, such as government securities or mortgage-backed securities. This injection of liquidity into the financial system aims to lower long-term interest rates and stimulate economic activity. 6. Supervision and regulation. Financial stability. The Fed plays a role in supervising and regulating banks and financial institutions. This oversight is crucial for maintaining financial stability and preventing systemic risks that could impact monetary policy goals. 7. Economic data analysis. Data-driven decision-making. The Fed closely monitors economic data, including indicators such as inflation, employment, and GDP growth. Data analysis informs the Fed's decision-making process and helps shape its monetary policy stance. 8. Dual mandate. Maximizing employment and price stability. The Federal Reserve operates under a dual mandate from Congress, emphasizing the goals of maximum sustainable employment and price stability. Balancing these objectives requires a nuanced approach to monetary policy. 9. Independence. Policy autonomy. The Fed operates with a degree of independence to insulate monetary policy decisions from short-term political considerations. This autonomy allows the Fed to focus on longer-term economic goals and stability. 10. Crisis management. Response to crises. During economic crises or financial emergencies, the Federal Reserve may take extraordinary measures to stabilize markets and restore confidence. This can include emergency lending facilities and unconventional monetary policy tools. 11. International coordination. Global economic stability. The Fed collaborates with other central banks and international organizations to promote global economic stability. Coordinated efforts can be crucial in addressing cross-border challenges and financial contagion. Conclusion. The role of the Federal Reserve in controlling monetary policy is fundamental to the stability and functioning of the U.S. economy. Through a combination of interest rate adjustments, open market operations, regulatory oversight, and crisis management, the Fed seeks to achieve its dual mandate of promoting maximum employment and maintaining price stability. The dynamic nature of the economy requires the Federal Reserve to adapt its policies in response to evolving economic conditions, making it a key player in shaping the nation's monetary landscape.